Now, the question is, when you prepare the financial statement, which currency you need to use? That is the key issue. So this standard is here to assist us. This standard is here to assist us as to say, what are the principles of converting from one currency to the next? And what is the functional currency? So if your company is based in South Africa, let's say, for example, it has listed in Johannesburg Stock Exchange, it tells you that when you prepare a financial statement, you must prepare it using the rands. So what it means is that whatever you buy abroad from other countries, because they use a different currency, you need to convert it into South African rands. And as you do that, you might run into a loss or you might make profit. You know, for example, the dollar to rand exchange, it goes up, it goes down. And normally when you place an order and it takes some days for that order to be completed, you might find that you are placing an order today and rand to dollar to rand is 15 rand. And by the time you receive those goods, it's 20 rand. So it has went up. So this standard tells us as to at which point you can recognize a loss or a gain. So that's what we'll be doing today. And we're going to look at the principles first, and later on we'll look at question number 1 and question number 2 of the question banks that you have. Question number 1 and question number 2. All right, so let's look at what is going to be expected of you guys. When it comes to foreign exchange, only journals is going to be expected of you to know how to prepare the journal entries. So you should be able to process the journal entries. And journal entries, as I've indicated in the previous classes, these are easy tasks to do because as you read information, you are able to see what are you going to debit and what are you going to credit. I'll give you a simple example. If a company receives a loan of 2 million, so we know that in terms of accounting, we say the company has received money, you go into debit bank, and it's with regard to what? To a loan, and then you're going to credit loan with the same amount. So that's how journals easy are. Even though I know that when it comes to foreign exchange, there will be calculations that we'll need to do, but I can assure you that as you read information, you should be able to see which journals am I going to process so that you can have the complete journals. All right, some of the important definitions that we need to know. First and first, whenever you're reading the foreign exchange transaction, as you read the information, it is very important to determine when is the transaction date. So from time to time, you will see words like cost, insurance, and freight, CFI, free on board, delivery duty paid, delivery at terminal. All these words are very important because they determine the transaction date, and the transaction date differs. For example, the transaction date for cost, insurance, and freight is not the same as delivery duty paid. So as you read the questions, when you identify these words, this information will be given to you as to what type of contract was entered. That will tell you when is your transaction date. When is your transaction date? So let's look at CFI. So when it comes to the CFI, so what it means is that it's an expense. So it's an expense paid by the seller. So remember, in each and every transaction that we're dealing with for foreign, you will have the buyer and the seller. So now the question is, who needs to pay what? Which expenses are going to be paid by the buyer? Which expenses are going to be paid by the seller? So when it comes to the cost, insurance, and freight, so the expenses will be paid by the seller to cover the cost of insurance and transporting the goods. However, once the freight or whatever you bought is loaded, then they become the buyer becomes responsible for all other costs. So now, when it comes to foreign exchange transaction, we need to know that if we have this type of a contract, which is CFI, at which point, then we're going to start to recognize our transaction. So the moment the goods pass over the ship rail, in other words, at the port of the foreign country, the moment they are loaded onto the ship and they are ready to come to South Africa, when it comes to CFI, then that will be our transaction date. That will be a transaction date. Same applies on free on board. The moment the goods pass over to the ship rail in a foreign country, then you as the buyer, at that moment, once it's loaded, then you are becoming responsible and you must recognize the transaction date at that point. Then let's look at delivery duty paid as to what is this. So a delivery duty paid is a delivery agreement whereby the seller assumes all the responsibility, risk, and cost associated with transporting the goods until the buyer receives or transfers them at the destination port. So in other words, you as the buyer, you take responsibility of the goods the moment they are cleared by your custom. I've indicated South Africa here because we're in South Africa, and normally the companies that you will be receiving will be South African companies buying from foreign companies or foreign countries. So the moment cleared by custom, that is where now you start to recognize the transaction date. So this table becomes very important. So one of the techniques you can use is when you prepare for this topic, make sure you cover all these. CFI, FOB, DDP, and DAT. Make sure you do the questions to cover because you don't want to get a surprise come in a test, come in the final assessment. You only prepare CFI, they give you DDP and you don't know how to treat it. The last one, delivery at a terminal. So this is where the seller clears goods for export and is fully responsible for the goods until they've arrived at the named terminal at the end destination. So the goods must be unloaded at the terminal. This is very important. So if delivery at terminal is used, then it means that from the moment the goods are shipped, let's say for example from US harbor until they reach Durban or Cape Town harbor, until they are unloaded at the terminal, the seller is still responsible. The moment they are offloaded to this site, then you as the company in South Africa, you are responsible now. And that's where the transaction date is starting. All right, so let's move forward. If you want me to repeat anything, you are more than welcome to type it on the chat. I'll check it and repeat it. So there are important things to consider when it comes to foreign exchange. Transaction date, which I just spoke about it. The information will tell you when are we going to account as a transaction date. Payment date, very important because there are journals that you need to process on the payment date. So when the payment is happening, we'll discuss when we do the actual question as to what needs to happen. Year end, very important because when you reach year end, if you've been given a loan, you must record for interest. You must also record for foreign exchange movement. Foreign exchange movement could be a gain or loss. We'll see it when you do the actual exercise. As I've indicated that we'll go through question 1 and question 2. One other important thing before we go to the question, I want us to understand this relationship. So when you read a question and they're giving you foreign exchange and they're saying 1 rand, for example, equals to $1. 1 rand equals to $1. I'm just giving an example. though we know in reality it's not like that. The dollar is always superior than the rand. Let's say, for example, 1 rand equals to $1. Then if you get foreign exchange given as rand dollar, you must divide. This is key, because if you go and you don't apply division, that means every conversion that you did is going to be wrong. And when you're given dollar to rand, you must multiply. I hope this is clear. So don't get the confusion here. The most important things when you receive a question, we'll see it when we go to the questions. Question 1, I think, is dealing with the first part, and question 2 is dealing with the second part. Rand to dollar, when you convert, when you divide. Dollar to rand, you multiply. Now, let's look at the rates to use. We will be given foreign exchange rate. So if you're dealing with the assets and liabilities, you must use the closing rate. You must use the closing rate. If you're dealing with income and expenses and other comprehensive income items, then you must choose what we call historical rate or average rate. And you can only use the average rate if the exchange rate does not fluctuate a lot. So now the question is, what happens if these rates are fluctuating a lot? Then the standard stipulates that we cannot use the average rate. So it is very important that when you're recording all the transaction, you determine as to, are we dealing with the assets or liabilities, or are we dealing with the income and expenses? Because if we're dealing with the income and expenses, for example, interest, you must use an average rate, provided that the exchange rate are not fluctuating a lot. We'll see this as we read the actual question. Now, we are on the question, name it class example number 1, but this is the question that is on the question bank, the first question. That's what we're going to look at it and try and apply the principles which I was explaining. And after the class, I'm going to share these slides. Those who want to use it, then they can use it. I'll share it via the class rep and also the recording for this session. Once I receive it, I'll share the link for the recordings. So let's look at this class example number 1 or question number 1. As a norm, we normally look at the required, and then we can go and read the information provided to us. In this case, as I've indicated that we can expect this, they want us to prepare the journal entries of this company for the year ended 31st December 2017 and 2018, 2 financial years. So we're going to prepare the journals for the year ended 31st December 2017, as well as for the year ended 31st December 2018. Again, the question specifically states show all calculations. What does that mean? That means then, if you're writing this on a test or on an exam, there will be marks allocated for calculations. If you don't show the calculation, you lose those marks. All right, so now let's go and look at the information. As I read this information, we'll be tying it back to the principles that we looked at it. International Accounting Standard number 1. It's a big standard, but that's what is expected at this level. As example, I've said class example number 1, inventory CIF. You don't need to worry about that. We'll see the the information that we dealing with him for 2017 and 2018. So the question reads as follows. The following Puma Limited is pre-sale baking machines. That means baking machines is inventory to them. Then on 1st January 2017, Puma Limited 100 baking machines at a price of $2,000 each from the US. So now, on the 1st of January, they ordered the inventory, which is baking machines, and they ordered 100 of those machines. And the price in terms of US dollars is 2,000. Then on the same paragraph, it says that the shipping documentation states that the risk and rewards will pass to the buyer in terms of cost, insurance, and freight, CIF, terms and conditions. This is what I was explaining on the earlier, when we started with the class. It's very important to understand. So now, by just reading that information, I can tell you that our transaction date, it is going to be the day this machinery is shipped over from the US harbor, because they bought this machinery from the United States. So that is very important. What are they using? The terms and condition, CIF. And if I go back to the CIF here, it says to me that in order for me to determine the transaction date, it's when the goods passed over the ship rail in foreign country. In other words, once the freight loads, the buyer becomes responsible for all other costs. And that's where the transaction starts. So when you're dealing with the foreign exchange transaction, it's very important to know when is it going to be a transaction date. That is the starting point. Once you know the transaction date, then everything will fall into places. Because think about it, the order was made on the 1st of January 2017. So now the question is, what transaction are we going to record there? They're just ordering. But until we know when is the CIF terms and conditions are met, then we don't know the transaction date. Let's proceed with the next paragraph. On 15 January 2017, the baking machines were completely manufactured and ready for delivery. Okay, now the question that I have for you guys, is this a transaction date? And the answer is no, because they are not yet shipped over to us from the USA harbor. Then let's proceed. The baking machines were delivered over the ship's rail at the port of shipment on 31st January 2017 at Texas, United States of America. This is the day, our transaction date, 31st January 2017. This is the transaction date because this is when now they are delivered over ship rail at the port of shipment. So whenever you read each and every question of foreign exchange and transactions, it's, as I've indicated, it's important to see what type of contract are we using. Here we are using CIF. So if you're using CIF, then when is it going to be a transaction date? Remember, I indicated here that one of the most important things, you need to know when is the transaction date, when is the payment date, and when is the year end. Those are the key dates. And in all those dates, we'll be processing journal. So the first journal that we're going to process for this transaction will be on the 31st of January 2017. Why? Because this is the transaction date. All right, let's proceed. The baking machine were offloaded on 15 February 2017 in Richards Bay, South Africa. They in KZN. The baking machinery on arrival in South Africa must still be assembled before resale at a cost of 2,000 Rand each in cash by Puma Limited. Think about the journals. I've just indicated to you that the first journal that we're going to process, which will go to it will be on 31st December 2017. And on the 15th of February, we have assembled this machinery at 2,000 each. And remember that it was 100 of them. Then these costs will be capitalized to our machinery, which is our inventory on this date. So this is going to be our second journal. You will see when we go to the calculations. All right. The next paragraph, the baking machinery will be sold at a 20% markup on cost price. I hope at this point we know how to use markup on cost price. That is the easiest way to deal with. On 31st December, which is our year end, the first year end, 30 baking machines had been sold. Remember, we ordered 100. So at this point, we are selling 30. And again, I'm going to say it, this baking machinery is our inventory. So in other words, we sold 30 of our inventory that we have, the 100. Then we need to recognize the transaction. There's two transactions we want to recognize here. There's a sale that we made. And once you make a sale on inventory, we need to reduce our inventory. And how do we do that in terms of the journals? Think about it. Inventory is an asset. We know that, right? So assets decreases on the credit side. So you're going to credit your inventory with the 30 that has been sold, and we're going to debit cost of sales with the 30. So we just need to determine the rent value, which we'll do in the next slides. But it is very important to read the information and try to understand there was a sale of 30 of this inventory that we have, and therefore we need to recognize revenue. We also need to recognize that inventory has been sold. Again, they're indicating that during the year 2017, 3 baking machines were returned to the USA because of faulty parts and had to be written off from companies' financial records. This is another transaction we need to deal with. And think about the journals like that we're going to deal with. Inventory is going to decrease, and we're going to recognize inventory return off that goes to the profit and loss. So in other words, we're going to debit inventory return off and credit the actual inventory. So by just reading this paragraph on its own, we can process 3 journals. Let me read it again and then just recap and say which journals are we going to process. The baking machines will be sold at revenue. Revenue is an income. Income increases on the credit side. We're going to credit revenue and we're going to debit bank if we've sold this on cash. So if the information doesn't tell you whether things has been sold on cash or on credit, it's safe to say it has been sold on cash. It's safe to say it has been sold on cash. The last part, we say during 2017, 3 baking machineries were returned. In other words, it needs to be written off from the company's financial record. In order to write off that, we credit our inventory and we debit our inventory return off that goes to the profit and loss. So far, so by just reading But just reading this information, I can safely say that we'll be able to process our journals. We'll be able to process our journals. So let's proceed and see other information that we have regarding that. Then we'll start talking how to analyze this information and how to process these journals. The payment terms. The payment terms of the bagging machinery bought on credit are as follows. In other words, we bought those inventory in credit. Then we'll be charged an interest rate of 10% on outstanding creditors balance. The repayment of this inventory that we bought on credit is going to be 1st January 2018, which will comprise of 100% of credit outstanding, including interest. Very important, this information that is given. So when we pay back the inventory that we got on credit, on the same day, we'll also pay the interest charged. So you will realize that our first year end was in 2017. Our second year end is going to be 2018 when we deal with the payment. So in other words, the journals required here is for 2 financial years. We'll process the journal for 2017 as well as for 2018. 2018 is when the payment has occurred. Remember, I've indicated that there are 3 important dates: transaction date, year end, and payment date. Very important. Those days are very important. Then they provide us with the foreign exchange rate. Again, the other thing to look for, it's rand to dollar. It's rand to dollar. So that means that every conversion that we're going to do will be divided. Very important, because if you miss out that and you go and apply the other way around, you multiply in this case, everything that you convert, you're going to get it 0, and you may end up not getting even a single mark. You may end up not getting even a single mark. So be on the outlook. Make sure you understand that this is rand to dollar, and rand to dollar we divide. The financial year end for this company is 31st December. And it can be assumed that the foreign exchange rate change at a constant rate. Why are they giving us this information? This information is very important. So in other words, when it comes to the income and expenses, we can use an average rate because it was rate. So the fluctuation didn't go in the abnormal way. This statement, it goes hand in hand with this information that I've shared before. Income and expenses and other comprehensive income, the rate you must use the average rate if exchange rate does not fluctuate a lot. So when we read here, they're indicating that it can be assumed that the foreign exchange rate changed at a constant rate, so something that is acceptable. So it means that we can use the average rate. And remember, we use the average rate when it comes to income and expenses and other comprehensive income items. All right. So that is the question, and they want us to process the journal. I've been talking about this. We read the information that this is where we're going to process the journal. So let us just recap. For you, when you practice, maybe this is not necessary, but for explanation purposes, we're going to do it. Risk and rewards will pass to the buyer in terms of CIF. So we know what does this mean. That means that the transaction date, the date shipped over the rail, then comes the transaction date. Financial year end, 31st December 2017 and 2018. The repayment date, 1st January 2018. bagging machines still need to be assembled. In other words, whatever cost we're going to incur, we're going to capitalize it on our inventory. Bagging machines will be sold at 20% markup on cost. We'll see the implication of that in no time when we process the transaction or the journals. 30 bagging machines were sold during 2017. 3 bagging machines were returned to the USA. Exchange rate, rand to dollar. What does that mean? We divide. This is on a high level, just the summary. It's not everything, but just the summary of what we got. So now let's look at the calculations. I just did the table so that these calculations become easy for me and easy for me to process the journals. If I read this information, I can process all the journals. This is what I did. I put the date first. Let's look here on the date before we looking at the information that goes with those dates. For example, the order was placed on the 1st of January 2017. On the 15th of January 2017, it was manufactured and it was ready. All this information I'm getting from the question. 31st January 2017, it was delivered over ship rail. Then that becomes my transaction date. 15 February 2017, assembled at Richards Bay in South Africa, then capitalization. I spoke about that. 31st December 2017, there's quite a lot that has happened on 31st December 2017. You will see that I've just break it down. Let's deal with first thing first. There was a sale I spoke about in detail regarding this. And there were 3 machines that were written off. And I spoke about that. When there's a sale, then that means our inventory is going to reduce. And we must recognize sale and we must recognize the write-off. Just the details. We'll go to the calculation and explain. Those inventories. So we must go and determine. I've indicated because interest and expense, we use average. Will talk us to how to calculate the average rate. Always be on the lookout. We use the average rate. Then, still with the interest, because we haven't looked at the more. So it's we need to determine that. That's why the standard is here. We need to determine that, and it is recognizing to process the journal for that. On 31st of December, now, because here at this point we have been paid the amount that we are owing, we need to check whether we've made a gain or loss on the loan amount, on the actual amount from the beginning. Above, we're talking about the interest. Here, we're talking about the actual amount that we loaned for this inventory. So, in order to do that, we compare the 2 rates, the transaction date rate together with the year-end rate. Lastly, on the 1st of January, which is another financial year, this is where the payment is happening now. This is where the payment is happening. And I'll explain how do we recognize such. So let's come back here. First thing first, on 1st of January, 100 bagging machines were ordered from US at $2,000 each. And here's the calculation. So if I convert 100 multiplied by 2,000, it's going to give me 200,000 US dollars. So I've indicated here in rand. Is there anything that I need to recognize? No, because it's not yet transaction date. 15 January 2017, then this inventory was manufactured and ready for delivery. Still, there's no transaction that we are going to recognize in rands. on the 31st of January 2017, delivered our ship. This is the transaction date. So what do? We'll take the 200,000 with 0.10. 0.10, we got it. It's the foreign exchange rate at 31st January 2017, which is our transaction date. And we divide, as I indicated, that if you look at the foreign exchange, it's rand to dollar. Then we divide. If you go and multiply it, you'll get a bigger figure, and at the end, you won't get the correct amount. So rand to dollar. So we divide, then we get 2 million. So this is the first transaction that we must go and debit inventory in the form of the images that we receive and credit foreign creditor or loan, because we've been loaned. When you read this information, we've determined that we didn't pay in cash. We were loaned, or we bought this thing in credit. That's why we say foreign creditor or a loan. This is the first transaction that we're going to process. Debit inventory as we are receiving it, credit foreign creditor or loan. We'll see it when we go to the journals just to confirm that. Then, this is the journal I'm referring to. On the 31st of January 2017, inventory debited foreign creditor 2 million. Now, let's go to on the 15th of February 2017, we're still in 2017. So they were offloaded in Richards Bay in South Africa and assembled. And it was 2,000. So we're going to capitalize it. You know, to capitalize it, that means we're still going to debit inventory, which is our machinery, and debit bank, because we paid for that assembly, is 200,000. So up to this point, if someone come and ask you what is the value of inventory, you just come in and say there's debit here for 2 million and there's debit here for 200,000. Our total value of inventory is 2.2 million up to this point, up to 15 February 2017. Very important, this capitalization that has happened. Right, now, no more other transaction until 31st December 2017. And this is where now we know that there was a sale of 30 machines and 3 were written off. And as I've just indicated, that means that our total inventory that day was 2.2 million. 2 million plus 200,000. So now we want to determine the value of those that we sold. It's only 30 out of 100, right? 30 out of 100 multiplied by 2.2 million is going to give you 660,000. So what we're going to do, we're going to credit inventory and debit cost of sales. This is the journal that has been processed there. 660,000 cost of sales, and then we credit inventory. So we're recognizing the cost of goods sold. On the same note, as we have sold something, we expect to receive revenue. Then what we do is from the 30 that was sold, which is the value is 660,000, you apply the markup on cost. So 660,000 multiplied by 120% or 1.2 to give you 792,000. So we're going to debit our data and credit our revenue. As I've indicated, in this scenario, it was never stipulated whether we sold it on credit or on cash. So you're more than welcome to, you can use the bank, you can, either way would be marked. Unless if the question is specific to say we sold these inventory on credit, then that becomes a data. Then we should be able to see 702,000 debited, 702,000 creditors in the form of revenue. We are recognizing the sale. Then there were 30, not 30, there were 3 of these that were 3. So in order for us to decision 3, 2.2 million multiplied by 3, that will return up to 100 is 66,000. So in other words, for the one that will return off, then here's the general. You must debit inventory return off, credit inventory 66,000. 66,000. All right. I hope we're still together. Now we'll be coming to the more interesting part. I think this is where the IS 27 more applies. I'm not saying on the transaction date it doesn't apply, because that tells us that on transaction date you must convert it from foreign currency to the currency that you're using. All right, let's look with regard to interest rate. As I've indicated, interest is an express, then we're going to use the average rate. How do we determine average rate? Very important. How do we determine the average rate? Because it's not given. In other questions, it could be given. Here it is not given. That means we need to calculate it. We can calculate it. So, in order for us to determine the average rate, we're at year end. We need to go and take the spot rate at transaction date and add it with the spot rate at year end. So we need to add these two and divide by 2. It's going to give us an average rate. Yeah. And this is the spot rate at year end. In other words, on the 31st of December. So you take the 2, you add the 2, you divide by 2. It's going to give us 0.11. This is the average rate we must use to calculate our interest. If you look at the information, interest rate was 10%, so we took 200,000 in dollars. We multiply that by 11 out of 12. Why 11 out of 12? Because it's from end of January until December. In other words, it's from February until December. That is 11 months. And then, in order to get the conversion, because it's rand to dollar, you divide it by the average rate, which we just calculated here. It should give you 166,667. Then that is the general we need to process. So when we're dealing with the interest, so we need the interest is going to increase the loan, because so think about it. If you go and borrow money, 200,000, and come near edge, like in this case, you're charging interest of 10,000, for example. You haven't paid anything, so you must add it on top of what you owe. So the interest is going to increase our loan. The interest rate is going to increase our loan. This amount is going to increase what you owe. So instead of us owing 200,000, then we need to go and add 20,000, which is in US dollars. In other words, now we are owing 220,000. That's what it means, because we haven't paid it. And then here we just convert it into rent, and we recognize it as fact that our loan has increased now. But once again, also we're still with the interest. Once again, we're still with the interest. Because we have been paid, we must look at the movement. What do I mean by that? So this is the average rate, and our year-end spot rate was 0.12. Now we need to determine whether we're a gain or a loss. Whether we have a gain or loss. In this case, we have a, so at year end, our spot rate was 0.12, and at the average one was 0.11. So if you take 20,000, you divide it by 0.12, and you multiply by 11 divided by 12, will give you 166,000. And then if you take 20,000 again, multiply by 11, so there is a gain of 13,889. And in order, our gain is going to reduce our load. So when we go to the journal, here, our load is reducing and we're recognizing our gain. Right? 13,889, 13,889. I hope we're still together. So now, 31st December 2017, on the actual load, which is 200,000, we need to compare the spot rate on the transaction date and at year end. We need to compare the two. And if we do that, then we'll realize that again that we have a gain of 333,000. How do we determine that? This is the spot rate at year end. This is the spot rate at transaction date. So that means that this also reduces our load. Any gain reduces your load. Any loss increases your load. Then the last part, the payment date. So on the payment date, if you go and read the information and say you are going to pay the amount that is outstanding that you are owing, or the creditor, including interest accrued. So the total value of interest accrued is, in terms of US dollars, is 18,333, and we were owing 200,000. So the two amounts are going to be paid, and when we pay, we credit bank. So we add the two amounts divided by 0.05. 0.05 is the rate on the day we pay. Then, if we do that, you must get 4,366,660. If we do that, then we need to determine as to actually how much are we paying for the creditor and the loan. How much? Not the actual cost. We use the spot rate at year end, which was 0.12. So you add again 200,000 plus 18,300,000 divided by 0.12, you will get 1,819,442. Then the difference will be your exchange loss, because our credit is bigger than our debit. Then it's foreign exchange loss. All right. That was all about question 1. I'll quickly run on question 2. The same principles we're going to apply. The only difference here that I want to show is the dollar to rand, and which you multiply. This should be much quicker. Let's look at what is required. Again, we're required to prepare the journal for the year ended 30 June 2017. You must show all calculations. Let's quickly read the information. As you can see here, it's DDP, delivery duty paid. Now it's no longer CIF. All right. So what did we say about the delivery duty paid? Just to recap here. Delivery duty paid. So the transaction date is when the goods or whatever we bought is cleared by customs in South Africa. Very important. So if you quickly go through the question itself, say they limited place an order for cell phones with P Limited that is situated also in the US on 1st December 2015. On 1st June 2016, P Limited shipped the cell phones to D Limited on a delivery duty paid basis. So this is the contract. On 25th June 2016, the container with the cell phones docked in Durban, South Africa harbor. On 1st July 2016, the containers were cleared from customs and taken into possession by Day Limited, who deliver it on the same day at their shop and ready to be sold. Now, coming back to the issue of transaction date, 1st July 2016 is our transaction date, because this is when they were cleared from customs. Very important. We can use the same information and remove the DTP and come with the CIF. It changes everything. Or the FOB, changes everything. So transaction date, very key, very important. But I've shown you on the slides previously that this is how you determine it. In this case, this is the transaction date. All right. Additional information, the financial agreement for payment of the cell phones were the following. Selling price of all cell phones charged by PIN Limited was 50,000 in total cost. So now we know it was 50,000, the total cost. Interest is calculated from the date that Day Limited took the significant risk and rewards associated with ownership from PIN Limited. And because they're using DDP, it's from 1st July 2016. The agreed interest rate is 10% per annum. The interest is payable when the cell phones are paid in full. In other words, again, when we pay what we owe, we must also pay interest on the same day. Day Limited paid the total outstanding amount to PIN Limited on 2017. Very important again. Transaction date, payment date, and year end. The cell phones are sold using markup on cost, 30% on cost price, much easier on the markup. On 30 June 2017, 50% of cell phones has been sold on credit. Now here they're telling us on credit. A sale made on credit, that means we're going to debit data, credit revenue. 1% of cell phone was broken and should be returned off. Again, return off. This is more like repetition of what we did. But what I want us to spend more time on is here. The following foreign exchange rates are applicable. Dollar to rand now. Multiplication. Very important. It can be assumed that the foreign exchange rate change at a constant rate. Again, then that means in order for us to calculate interest, we can use the average rate. Required to provide the journals. Let's spend some time here. Analysis is just the recap of what happened. Shipment was made DDP. Repayment 30 June 2017. Year end 30 June 2017. Cell phone inventory 50,000 in total cost. 50% of the inventory was sold on credit 30 June 2017. Cell phones are sold using a markup of 30% of cost price. Exchange rate is dollar to rand. Calculations, again, I've listed in terms of the dates. On the 1st of December 2015, cell phones were ordered from US. No transaction happened here, just placing an order. All right. 1st June 2015, shipped to Day Limited. There's no transaction that has happened here. But if we're using the CIF or FOB, this was going to be a transaction date. But because we're using the DDP, then it's 25 June 2015, container docked in Durban, South African harbor. So clearance not yet happened. So there's no transaction. 1st July 2016, it was clear from custom. Then that becomes our transaction date. And then we can recognize in rands 50,000 multiplied by 7 rand, because at that date it was 7 rand, the spot rate. And then we get 350,000. The journals, again, what's going to happen? Debit inventory, credit, foreign credit. Similar to what we did in the previous exercise. I'm more concerned in terms of explaining. 30 June 2017, year end, there was a sale. 50% sold, 1% return off. We know what to do when it comes to this one. So 50% of 350,000, 175,000. So if you take, and then 1% of that, it is 3,500. 30 June 2017, year-end interest. There, now we're calculating the average rate. Don't forget we use the transaction date and the year-end is going to give us R7.10. Payment date, we paying the loan plus the interest. We're paying the loan plus the interest. So the rate that we use here is the year end. The rate that we use for foreign credit loan is the transaction date. The rate that we use for interest loan, it's R7.10. And that's all I wanted to explain when it comes to foreign exchange. Please, when you practice the foreign exchange transaction, as I've indicated, make sure you do one question that is dealing with CFI, FOB, DDP, and DAT. Go and do those questions, practice them, make sure you understand and how you apply the transaction date and all other transactions. Then you will be sorted. All these questions are there in the question banks. I think in the question banks, it has quite a lot of questions. I think it has question 1 until question 14 for one to prepare for the test and the final assessment. Make sure you cover CFI, FOB, DDP, and DAT. Then from my side, that's all I have, unless if you have a query with regarding to any of the questions that we did, then you're more than welcome to send it on the chat. If you don't have a question, then that will conclude our class. Thank you very much for coming through. I hope to see you again on Wednesday. So I'm still here. Any question? Otherwise, then the class conclude.